Good afternoon, and I'd like to firstly thank Groww for investing in bear markets. It might sound a little cliche, given that everyone would be telling you that these are unprecedented times. But quite clearly, in my last 25 years of being in the mutual fund industry, I would definitely have to say that these are unprecedented times. The reason I say this is because I would have personally seen quite a few bear markets, but in those bear markets, the front of the markets was felt more from an economic standstill rather than what is going on today. Clearly, not only the economy has stopped, but life in general seems to have stopped and slowed down. So I think it would be naive to believe that these markets might show similar patterns of the earlier markets. Quite clearly, there are a lot of answers yet to be resolved in terms of when this pandemic will end, how will the virus spread slow down, how will economies and markets react to it. Having said that, we thought it is interesting to look back in times when markets have fallen so sharply and markets are as volatile and turbulent. So to start off with, let us firstly look at what is the definition of a bear market in its very technical perspective. So a bear market is one where a market experiences prolonged price declines. Typically, we assign a market to be in a bearish mode where securities prices fall 20% or more from recent highs. And typically the falls happen because there is widespread pessimism and deep negative investor sentiment. This is a journals or websites. As we speak, from the earlier peak, the Nifty 50 TRI, which is the Nifty index, is down 26% YTD as of the 16th of April of this year. Just to flashback in the last periods, what have been the various bear markets we have seen. In the last 25 years, there have been 4 instances of the bear markets as defined in the earlier slide. The first was the Asian financial crisis, where a lot of the emerging markets had a pressure on their respective currencies, and most of the currencies in the Asian markets fell, and that led to the first of the crisis on the indices. The second was quite clearly, most of us would be fairly familiar, the tech bubble, where all stock prices went into a dizzy till 2000 and pretty much collapsed after that, after the Y2K phenomena passed through. Third was the global financial crisis. This was one of the severest stock market crisis or economic crises the world faced. I, for one, know a lot of large institutions, and when I say large, these are institutions of the size of close to $100 billion, vanishing literally overnight basis the global financial crisis. And last but not the least, we've come to face the recent crisis, which all of us have come, the COVID-19 crisis, which we are all living through. Global financial crisis is a data point we would want to refer to right through the presentation. And like I stated, if you look at what happened in the Indian markets during that time, was the Sensex actually corrected 60% in a period of 15 months. Now, to put things in perspective, if you bought something at 10 rupees, the value was down to 4. And that's the severity of the fall the Indian stock markets faced over a period of 15 months. Now, compared to the GFC crisis, we actually, relatively speaking, while every loss is a loss which investors are difficult to fathom, we've actually fallen close to 40% during the current crisis in a matter of 2 months. I think what is hurting for most investors is the recent investor experience has been little more dampened, given the fact that for the last 12 to 18 months, markets were moving in a shallow range. There was a little bit of a glimmer of hope when the market started to go up, and suddenly this crisis happened and markets have collapsed close to 38%. Having said that, we thought, let us flash back to the GFC and said, okay, if there was one leg of the journey where the markets fell close to 60-70%, how did the stock markets come back from those levels? And is there a learning for investors in all of this? Having said that, I would want to reiterate that at no point are we saying that the pullback or the market climb would replicate or mirror what had happened in the earlier. This is just a data point we want to reflect on. And there is a likelihood that as things stabilize, you could see markets coming back in a similar manner or predictable manner. So post the GFC, if you look at some of the indices and their returns, it's very interesting that if you look at the fall, the large cap index, like I said, fell 60%. The small cap, the S&P BSE small cap index actually fell 80%. Surprisingly, gold, which is always considered a safe haven asset, rallied and went up 40%. The bond indices were up 11% and 8%. Having said that, what happened over the next 1-3 years were mirror images of what happened in the GFC crisis. So post the GFC crisis, the BSE small cap index, which had fallen 80%, actually went up by 200% over the intermittent next year. And over the period, effectively means that if things become closer to normal, the markets will start rallying ahead of the whole scenario being normal from a economic or even a personal lifestyle, because markets tend to move much ahead before the economy comes back into the full strength, and that's how the stock markets behave. Having said that, it was also interesting to look at what a typical investor does, and what we have find, despite repeated interventions, repeated messaging, that the only commodity which investors want to buy when the price is high, surprisingly, seems to be equity funds. And this is a behavior which is very, very different to every other purchase he or she does. And the analogy I keep giving is, ask each one of us a question as to when was the last time we went into a mall and bought a shirt or a shoe or anything when the item was not on sale. But what I have observed in my last 20-25 years is that there is a big tendency of investors to go and flock and buy into the markets when the markets are high. And hence a typical investor behavior is that if equity markets are high, you'll see the big queue. But when equity markets are off 40-50%, negativity and pessimism clearly overtakes investor behavior, and he or she tends to avoid, or if not get out of the equity markets, which we think is very, very poor way of investing and making returns over the long run. Having said that, I think the other aspect which most market experts, most mutual funds, and all of us who've been investing have been repeatedly saying, that time in the market is absolutely more important than timing the market. And what better than to look at the slide, which actually portrays the journey of the index from the year 2000 to the current 2020. If you are to notice the index value in the global financial crisis and the current financial crisis, you are still talking of an index which is close to 6 times the value what it was in the year 2000. And hence these sharp dips, if looked at in the perspective of a long-term journey, will get dissipated or erased as he or she continues to stay invested in the market. Around that, 2008 and stayed on for 5 years, how would your investment journey or experience be? And it's actually a very fascinating piece of data that if you had done a monthly SIP into the Sensex from the peak, and the value at the bottom, which was March 2009, your SIP would be down with a negative CAGR or negative XIRR of 33%. This is where we sense that most investors either pull out, stop, or actually close the SIP, seeing the massive fall in the value of investments. But what we find, if you as an investor stayed calm, believed in the whole concept of a systematic investment plan. The biggest advantage being that the lower the price of a unit, the more units you get, and hence it is imperative that you stay invested, especially in times when the markets are low. The same investor would have actually made a fairly healthy return of close to 9%, despite having invested at the absolute peak of the market and from a peak position where the markets fell off close to 60%. So despite a 1 year drop of 60%, an investor who had the patience to stay invested would have actually returned a very healthy 8.5% on his investments. Please note, these are investments made into the Sensex and not reflective on any particular fund. A similar analysis they've done of an investor who has invested from one bear to the other bear market, which is the global financial crisis to the current. And what we see is that if you had done a SIP into the index from March 2009 till December 2019, which is pretty much 2-3 months before the current crisis, your return on investments would be close to 11%, which all of us would accept is a fairly healthy return given the fact that inflation has been constantly in the range of 4 to 5%. Having said that, of late, what you would have seen is that your value would have taken a big knock, and if you had continued your SIP and its same investment, the value of your investment in terms of XRR would be close to 5.3%. And what we are starting to see is that we are getting a lot of calls from investors, distributors, my relatives, in asking me a very simple question: should I continue my SIP or not? And the answer I give is very simple. If you are done an SIP for a long-term goal or investment horizon, these are actually the best times to stay invested, if not add to the SIP. Having said that, if your SIP contribution to your salary is in excess of a certain percentage and you are finding it tough to maintain the same level of lifestyle or same level of comfort, it is not a bad idea to pause the SIP, but please do not stop your SIPs. I think if you think for the next 2-3 months, I may not have enough cash flows and the amount of SIPs I do to my total cash flows is very high, either stop some of the, pause some of the SIPs, but please do not stop. As and when things become normal, it's a great idea to restart the SIPs. And just to illustrate why I believe you should continue the SIPs, there is a feeling that the returns on SIP will be always linear and will always be positive. But when we looked at the indices data and ran it back till 1979, way back, what we found was very interesting, that there were phases where 5-year SIP returns have actually been negative. And the beauty is, if you as an investor still had the conviction, the patience, and the understanding of remaining invested, the next 5-year returns of an SIP which was negative actually gave you a return at a minimum level of 8% and a maximum level of 48%. And your next 10-year returns actually went from a minimum of 9.7 to a maximum of 22. Please remember, these are for SIPs which had given you negative to less than zero return over 5-year periods. It's not a 1-year SIP. And as you will see, interestingly, the lower the XIRR on a 5-year return, the corresponding 5 years returns are fairly healthy and strong, which effectively reiterates the point which I've been saying, that the power of the SIP is your ability to accumulate more when the price of the SIP or the fund you're buying is at a low, rather than doing the reverse when the price is high. And this slide actually illustrates the beauty of continuing SIP through market cycles. With that, I think I would end my presentation with 3 key takeaways. We urge investors, and as a simple method, we have used an acronym for SIP, saying that investors should continue your SIP and top up if possible. Invest, and we hope that you've been guided by your distribution partner, online partners, that you have to invest as per your asset allocation plan. it is again a very boring and repetitive statement when people tell you to look at your asset allocation. Trust you me, the secret sauce in making wealth over a long period of time is actually to get your asset allocation right. A lot of my friends who have reached out to me, if I ask them the basic question, what was your asset allocation on February 1 and what is it now? Everyone's asset allocation has shrunk on the equity side, but many are not able to fill that up. And that's where I think over the long run, the difference between making very good returns and good returns lies. Last but not the least, persevere. I think the beauty of a systematic investment plan is that this is a plan which has to see volatility for you to make much better returns than in a straight line method. And that's why please persist and be unemotional while investing. Having said that, I would want to close by saying that what we presented are examples of what had happened in the past. Like I started by saying, this crisis is a crisis which I bet most of us have not ever seen in our lifetimes. We really don't know what will be the outcome of this, but quite clearly, I don't think a crisis will be everlasting. And as and when things normalize, we think markets will take heed of that and returns will come back into your portfolio. With that, I would like to end my presentations in saying that stick to your plans, stick to your asset allocation. If it really push comes to shove, pause your SIPs. But from my perspective, what I have personally done is actually continued with my SIPs and even done marginal top-ups in most of my SIPs. With that, hope all of you are safe and sound. My entire team at IDFC Asset Management joins you in praying that all of us come out of this crisis much stronger. Continue with your SIPs, stay safe and stay healthy. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.